The shadow lords of crypto. Who are the whales and how do they manipulate the market? Imagine you bought Bitcoin, everything's calm, and in 20 minutes, it's down 10%. There's no news, panic in the feed, while someone is calmly buying up your coins. It's not a coincidence, it's liquidity. And today, I'll show who whales really are, what tools they use, and how they take money from the crowd. And most importantly, how to stop being their fuel. I regularly share my detailed trading setups completely for free in my Telegram channel. The link is in the description. On TikTok, I do live streams with real-time market analysis. Let's go. In the crypto world, the hierarchy is determined by asset volume. A whale is an owner of over 1,000 Bitcoins or 10,000 Ether. It's not just about the numbers, it's the raw ability to create widespread panic or euphoria with a single market order. This broad category includes massive investment funds, crypto exchanges, early miners, and mysterious Satoshi-era investors. The fundamental difference between a whale and a retail trader is their level of patience and long-term strategy. While the masses react to emotions, whales create the conditions for those emotions. The biggest whale in history isn't a fund, an exchange, or even BlackRock, it's Satoshi Nakamoto.
In 2010, Satoshi Nakamoto did something that changed the history of the crypto market forever. He publicly participated in Bitcoin's development, replied on the forum, and personally made edits to the code. Then he gradually began to disappear from discussions, handing key tasks over to other developers. In 2011, Satoshi completely stopped all activity and vanished without a trace. Since then, his wallets have remained untouched, and his identity has stayed one of the biggest mysteries of the digital age. To this day, no one knows for sure who was behind that name.
Market analysts estimate that addresses that are directly associated with early mining hold a total of about 1.1 million Bitcoins. That's billions of dollars. These coins are spread across thousands of different wallets and have barely moved for over 10 long years. Just imagine the massive scale if these coins suddenly start hitting the open market. It would be the largest redistribution of liquidity in crypto history. Every time a wallet from the 2010s era wakes up, the market freezes. Twitter explodes and on-chain analysts publish urgent trends. Volatility spikes sharply. In 2023, several old addresses transferred 1,000 BTC. And that instantly triggered a wave of panic. It is important to note that even if it is not Satoshi, but rather some of the very first miners, the very presence of such sleeping whales creates significant psychological pressure on the market. This isn't an actual sale, it's potential liquidity. And the market always factors in potential. If Satoshi is a shadow, then Vitalik Buterin is the face of open architecture.
In 2013, Vitalik Buterin published the idea of Ethereum, a platform that was meant to make blockchain not just money, but a full-fledged digital infrastructure. By 2015, the network launched and the market saw crypto for the first time where you could build applications, tokens, and entire financial systems. A few years later, Ethereum became the main engine of DeFi and NFTs, and Buterin himself became the person who effectively created a second center of power in the crypto world after Bitcoin. And here's the most interesting part. Unlike Satoshi, Vitalik didn't disappear. He still publicly influences the market with a single post or transaction. That's why Ethereum isn't just an altcoin, but an ecosystem that changed the rules of the game.
Unlike an anonymous whale, Vitalik is, not just a coin holder, he's the center of the ecosystem. When he transfers tokens, makes donations, participates in asset burning, the market reacts not just to the volume, but to the symbol. But the most interesting thing is that behind Vitalik stand the institutional whales of Ethereum. Funds, validators, staking pools. They control tens of thousands of ETH, participate in staking, and effectively influence network security, emission distribution, and the supply structure. In Bitcoin, whales influence through volume. In Ethereum, it's also through participation in consensus. These are two different types of power. Today's whales are no longer anonymous guys in hoodies. They're public companies with financial reports. MicroStrategy Inc., which is led by Michael Saylor, currently owns more than 190,000 bitcoins.
In February 2025, the company announced a rebrand. It became Strategy in corporate documents and in the brand instead of MicroStrategy. This change reflects the company's strategic focus on accumulating Bitcoin and positioning itself as the largest corporate Bitcoin treasury, rather than only a BI software developer.
This isn't speculation, it's a corporate strategy. The company has effectively turned into a Bitcoin proxy. By buying Strategy shares, investors get indirect access to BTC. Saylor publicly states, "I will buy Bitcoin forever." But the market doesn't look at words, it looks at the balance sheet. Because if such a player starts taking profits, the movement won't be emotional but structural. That's exactly why the actions of large companies aren't news. It's a shift in the distribution of supply. And now for the most systemic player, BlackRock. This isn't just a whale anymore, it's infrastructure.
BlackRock is the world's largest asset management company. It was founded in 1988 by Larry Fink. Today, it manages around $9 to $10 trillion, more than the economies of most countries. It holds stakes in the biggest corporations, from Apple and Microsoft to banks and oil giants. In 2024, BlackRock launched a spot Bitcoin ETF. And those who only yesterday called crypto a risk are now accumulating it institutionally.
Through a spot ETF, they're not just buying BTC, they're creating a channel for traditional capital to enter the crypto market. This changes the very nature of the movement. Volatility becomes institutional, liquidity is redistributed, and the market structure becomes more complex. It's important to understand, when large funds control a significant share of supply through ETFs, they don't manage the protocol, but they do influence the structure of demand, liquidity behavior, and market dynamics. It's not a conspiracy, it's capital. And in the world of capital, whoever controls the flow of money shapes the trend. How do whales make money off of you? There are three classic schemes. The shakeout, a whale sets up a massive sell order, a wall. The price stalls, beginners get scared and start selling. The whale pulls the order and buys up your coins at a lower price. A pump and dump scheme is a massive purchase of an asset to create the false illusion of rapid growth. When the retail crowd jumps on the bandwagon at the peak of FOMO, the whales exit their positions into them. Liquidity manipulation. They use news cycles to create volatility. Often, negative news reports appear exactly when an asset needs to drop for large-scale whales to buy in. The main thing is to understand that whales aren't evil. They're the market's energy. They create momentum and shape trends. But they are not hunting you personally, they are hunting for liquidity. And liquidity is just a crowd without a plan. If you enter without structure, without understanding the market phase, without analyzing volumes and stop clusters, you become part of the fuel. Remember one simple thing. The price consistently gravitates to where the money is. Not where it's mathematically logical, not where it should go, but where there's the most liquidity. So our goal isn't to fight the whales. Our goal is to carefully identify and follow their tracks. Tracks are seen in abnormal volumes, in false breakouts, in sharp impulses without news, and in accumulation before a strong move. If the market is unusually noisy and volatile, it means someone is building a significant position. If the market is too obvious, it means it's setting a trap. The crypto market isn't a casino, it's a field for capital redistribution. And the difference between a hamster and a pro isn't the deposit size, but understanding the structure. The question isn't whether whales exist. The question is whether you react to their moves or anticipate them. Because in this market, either you become liquidity or you learn to read those who collect it. The choice is always the same. And it starts with understanding. And now a question for you. Which crypto whales do you know? Do you follow their digital wallets, their investment funds, or official public statements? Write in the comments. it is certainly quite interesting to list those who are genuinely worth keeping a close eye on. If you like this market analysis, please consider giving it a quick like so I know the topic is important, and be sure to subscribe to the channel. Next, we'll learn to read the market instead of being its fuel.